Just over 51% of CFOs are expected the Dow Jones stock index to fall below 19,000 before reaching a new high. In the meantime, the Dow Jones stock index kept moving higher. Hello everyone, it's Cody here. If you're confused about the news in the US stock market, don't worry. In this video, I will talk about whether you should invest now or wait for the next crash. I'll explain why the stock market kept going up and at the same time why the stock market might be overly optimistic. Then I will share exactly what I will be doing if I were you. If you are brand new to the channel, I help people get ahead in finance, and I also collect good quality stocks and houses. So if you're into these topics, don't forget to like and subscribe to the channel. Let's get right at it. Here are 4 main reasons why the US stock market kept going up. Reason number 1, a cure will eventually come. It's not the first time we have encountered a global health concern. If we look back at history, we have had more severe outbreaks than this one. I'm not undermining the severity of this event, but we had always come together and come up with a cure eventually. Now, there are a lot of top pharmaceutical companies already working on a cure. It's just a matter of time when we find the cure and adapt to the new style of living. Reason number 2, the US economy is reopening, and we have been under a lockdown since earlier this year. Our economy, business, and even individual like us cannot withstand a lockdown for a long period of time. As the lockdown eases across US, the stock market is reacting to this positive news. Reason number 3, the US Fed step in. The US Federal Reserve have made it clear that they will do whatever it takes to keep the economy running. Even though we might be in a really bad situation for the Feds to step in, Feds will continue to supply the money to the market and keep us away from the credit crisis we had in 2008. Reason number 4, bad news already priced in. It's been 4 months since the outbreak. This is not a shock anymore. People are not as fearful of the situation as they were 4 months ago. The stock market is a forward-looking mechanism. The last earning report were doing poorly, but the stock market thinks that the next earning report will be significantly better than the last one. Therefore, people are starting to price in the next earning report. However, to counteract these arguments, here are 2 main reasons why the stock market might be overly optimistic. Number 1, unemployment rate is still high. Even though we are starting to see a decline in jobless claims, nearly 40 million people have filed for unemployment insurance since March. This might push the unemployment rate in the US to exceed 20%, where it was 25% during the Great Depression. The US government could be giving out stimulus check, but this is like putting a bandage on a wound. It doesn't fix the root cause if people are not employed. And this brings me to my reason number 2. People won't spend their money. The personal saving rate in the US has surged from an average around 7% to 33%. Bravo! You did it. I'm actually very impressed by the amount of money people start to save. This means that we're cutting back on unnecessarily spending and keeping it to the essentials. At the same time, it's very alarming to me as well. People are reluctant to spend money because they're not sure where to get their next paycheck. This means that people are not spending as much eating out, buying clothes, taking trips, and so on. This could take a heavy toll on many businesses. Without revenue, many businesses could go bankrupt. After analyzing why the US stock market keep going up and might be overly optimistic, this is what I would do if I were you, besides smashing that like button. First and foremost, I will make sure I have my emergency fund saved up in this high interest account. This money should be readily available to me on the same day I withdraw. I usually keep 3 months of my monthly expense. For example, if my rent is $1,000 and my car expense is $500 per month, I'll be at least putting aside 3 times of $1,500, which is $4,500 at any given moment. This amount should not be used to invest in stocks. Why not? If you use this emergency fund to buy stocks and the stocks goes up, great. But what if they go down and you need the money for an emergency? Then you're forced to sell the stock at a loss, knowing that the stock market will eventually go up. This is not a comfortable position to be in. So trust me, save up your emergency fund first before you start investing. The main reason is just to set the money aside for rainy days. Second, you will look for good businesses. Why? Because when you invest in stocks, you're actually investing in the businesses. Good businesses make money and pay their shareholders a portion of their profit as dividend. 2 key questions to ask. Number 1, does this company has a good dividend history? Company will only sustain their dividend in the long run if they are consistently making money. Number 2, will this company grow in 10 or 20 years from now? If your answer to any of these questions is no, you might just be speculating. And hope is not a very good strategy in stock investing or just any investing in general. Third, does this company have the market capitalization, which is the valuation of $5 billion or more? The reason why I only search for good quality blue chip companies because most of them are household names. Your kids or your neighbors should hear about the company. Big companies are more likely to weather the economical downturn. I know this will eliminate a great selection of stocks, but here is why. Some small companies could have more explosive growth. And I agree to a certain extent. From my experience, most of the small companies end up failing. So even if you hit a jackpot once in a while, the rest of the time you're losing money. It's just too difficult to pick the next unicorn in the stock market. You will make lots of money with a few stocks, but you might lose most of the money in the rest of the stocks. I will simplify the math and I'll show you what I mean. If I have $5 to invest in 5 good quality stocks and I evenly distribute the $5, I will invest $1 in each stock. If each of the stock has the same growth rate as the S&P 500 for the past 30 years, I will have roughly a 10% return from these 5 stocks every year. This will grow my $5 to $5.5 by the end of the year. On the other hand, if I invest the $5 evenly into 5 potential unicorns, it's very likely that 4 out of the 5 of these companies will fail and the stock price will drop by 80%. 1 out of the 5 stocks might become the unicorn and appreciates 100%. In this case, because we lost so much on the 4 stocks, even a 100% gain on the 5th stock will reduce our $5 to a $2.8 by the end of the year. With that being said, it's not impossible to have a higher percentage of success with smaller companies. However, you will really need to have the industry expertise and the know-how that average people don't have. Therefore, I would suggest beginner investor like yourself to only look for good quality blue chip company. Keeping the second and third point in mind, the 4th point goes hand in hand with them. Is this stock post-global health concern friendly? Some businesses will recover better than others. Once the economy reopens, we will adapt to a new form of living. This means that we might not be doing what we were doing as much before the global health concern. If you're still not sure about what to invest in, you can check out how I invest my own $10,000 in this video and top stocks to buy for 2020 in this video. These are the stocks that I personally invest in. The 5th thing that I will do, and this could be the most important one, utilizing the dollar cost average investing method. Do not invest all your money at once. The reason is because we do not have the crystal ball to predict where the stock market is going in the short term. A good news might come out tomorrow and push up the stock price, and the vice versa could also happen. At the same time, we do not want to keep waiting on the sideline because if the stock price kept going up, you might have just missed it. My suggestion is that you spread out your investment over the next several weeks. If you have $4,000 to invest $1,000 this week, another $1,000 next week, and so on until you run out of money. If the stock price goes down, you can average down your position. If the stock price goes up, you already got some stocks, and you can keep adding to your portfolio. This will help you get an average price for your stocks. In summary, the stock price is a forward-looking mechanism. Even though the economy is disconnecting from the stock market, it could keep going up. So make sure you save up your emergency fund in a cashable high-interest account. Only then you can consider to invest. And only look for good quality blue chip stocks because these companies are more likely to come out of this event even stronger. If you decide to invest, spread out your position over the next several weeks to achieve a dollar cost averaging investing. If you are still wondering how to start investing in the stock market, don't worry, I have created a simple 5 steps process for beginners like yourself. I will guide you from opening an online brokerage account, selecting stocks, and all the way to when to sell your stocks. Download the free ebook in the description. Or if you'd like to hear my insights on the market and bounce ideas with like-minded investors, feel free to join the private Facebook group by clicking the link in the description as well. If you like this video, don't forget to smash the like button, subscribe, and click the notification bell and change it to all. You can also follow me on Instagram. Thanks for watching and see you next time.